Thank you, everyone, and good afternoon. It's a pleasure to be here. My name is Nizam Hamid. I'm head of the sales for WisdomTree Europe. WisdomTree Europe is relatively new to the European market, came to the European market in October last year. I have a very extensive disclaimer, but I'm not going to read through the whole thing. It's along the lines of the disclaimer you've just heard. So what's WisdomTree at a glance? Well, we're the sixth largest ETF issuer, number 5 in the US market. We have the world's two largest currency hedged ETFs, actually both of which we've brought here to Europe. Our assets under management recently were about $55 billion, and we're the world's only dedicated listed ETF issuer listed on the Nasdaq Stock Exchange, so just focused purely on ETFs. Just from a corporate perspective, we acquired a leverage platform, Boost ETPs, in April last year. Won't talk about those because they're a completely different area in terms of suitability, but certainly was Europe's first platform for 3 times short and leverage ETPs. And we, as I said, we've had the fastest growing currency hedge ETFs globally, and that's been very important, covering Japanese equities and Eurozone equities. And that, I think, has brought across to people different types of ETFs from the perspective of the growth of the industry. And we acquired Europe's only Irish ETF in April of this year, which is also listed on the London Stock Exchange. So what are ETFs? Well, they fall under this sort of umbrella term of ETPs, exchange-traded products generally. So you have ETFs, which are funds, you have exchange-traded notes, which are clearly different in structure, and exchange-traded commodities, ETCs. I think the key thing to understand about an ETF, the most important thing is, it is very similar to a mutual fund, and one can really think of it very simply as being a mutual fund that trades on exchange. So it's open-ended, and that's very important in terms of the creation and redemption feature. An open-ended fund, that feature is incredibly important in terms of making sure that it trades very close to the net asset value, both daily and intraday. You can trade it on exchange just like any equity that you would normally trade. Normally you have a lot of liquidity because there are multiple market makers, and that gives you very tight pricing during the day for any of the ETFs that you see. Because they're arbitrageable, because there's price discovery, that means that they will trade very tightly and be very efficient. And they're normally very low cost relative to, I would say, competing products, especially compared to active funds. And so if you think of the differences between ETFs, ETCs and ETNs, ETFs are UCITS funds, and that makes them a completely different vehicle from a suitability perspective compared to, say, ETCs and ETNs, which in some cases may be compliant, but ETFs are, eligible, but the ETFs are UCITS compliant. So why are we interested, and why do we think ETFs are such a great industry and a great product that you should be involved with and use in your portfolios? If we look at the growth globally of ETPs, you're close to $3 trillion, about $2.9 trillion at the end of April this year. Been growing at around 29% per year since 2000. And a lot of that's been driven by simplicity and transparency, and also by a lot of product innovation. So you've gone through different cycles and different phases when it comes to the development of ETFs, both globally and in Europe. And I think that's really been seen by the actual figures that you can see here. Dominated really by ETFs that cover equities, about 2.4 trillion, about 2.9 is in equities. So coming back to this comparison between an ETF and a mutual fund. Well, mutual funds are really that very typical investment vehicle that you've probably all been using. So you're probably very familiar with a mutual fund. They're operated by money managers who might invest typically in an active strategy, whilst of course you do have passive strategies. But really, it's a portfolio of assets structured and maintained to match the investment objectives from the prospectus. So if we were to perhaps just compare quite simply mutual funds and ETFs, I suppose one of the key things about an ETF is they're very transparent vehicles. You typically will have all your holdings disclosed fully on a daily basis. Now you can compare that to an active fund, and yes, you have holdings which are disclosed, but clearly on a less frequent basis. With an ETF, you can go to any ETF provider's website and you will find daily disclosure of the holdings in the fund. The strategy, typically, especially for most of 99% of all ETFs you have in Europe, is really a quantitative, systematic strategy. So you're not taking the active manager risk that you would traditionally take with a normal active mutual fund. You have much broader range of types of market exposure that you can gain access to via ETFs. And an ETF will typically do one thing. It will match the index it's trying to track after fees and after other expenses. And in some cases, there's some extra positive revenues that come into the ETF equation. Whereas if you look at mutual funds, obviously they naturally, especially in the active space, seek to outperform their market indices. And as we'll see later on, that isn't always the case. ETFs generally cost efficient. You'll normally find that the TER on an ETF, again, it's very transparent. The total costs that you will see in an ETF, you will always find disclosed on ETF providers' websites. And that will typically be much, much lower than in the active space where you will generally find much higher TERs. Liquidity is great. I think liquidity has been very important, especially as markets have been very volatile over the past few weeks. So, for example, if you were involved in a mutual fund, you'd be able to trade that after the close or at a particular time. But with an ETF, you could trade any time during the day. And that's a very important feature to make available to you, the end client. So just looking at that growth of ETFs, and again comparing it to mutual funds, because mutual funds are historically or have been the traditional vehicle that people have been involved with. Here's a great example from the US market. And here you can see how popular ETFs have become in that marketplace. They've hit over $2 trillion, that's a great figure. But importantly, look at the growth of ETFs as a percentage of mutual fund assets. And you can see that actually over 15%. And that just shows you the degree of acceptance of ETFs as a vehicle, certainly in the US market, and we'll see later that it's been acceptable in Europe as well. But I think it's, just because you can trade them on exchange doesn't mean you have to only use them as tradable vehicles. The growth you see here in ETFs as a proportion of mutual fund assets actually highlights the fact that people are using ETFs as long-term buy and hold products. That's because they're also low cost. And if you think of costs over the long term, that's what can really eat into your overall returns. So being able to buy the cheapest, most efficient product that also has benefits of trading on exchange is a very attractive proposition just in terms of how an ETF operates and the value that it brings. And transparency, understanding what your product is, understanding the exposures that you have is very important as well. So in the European market space, behind the US, as we often are in many different things, hasn't grown to the same extent. Europe's not one marketplace, and clearly we've got different regulations across Europe. We don't have a single trading venue, for example, but you are starting to see the strength of that positive take-up in ETFs. And one looks at the evolution compared to the mutual fund industry, we're over 3%, about 3.7% in terms of market share. We see no reason to believe why ETFs that trade in Europe, they're as transparent as the products you see elsewhere in the world, why they won't get to the 15% level that you see in the US and perhaps beyond. Total assets are now over $500 million in ETFs in Europe. And certainly, again, attracted by exactly the same features that have made them very popular in other markets. So what are the differences here? And when I was talking about mutual funds and risk, I suppose mutual funds are the traditional product that investors have used in the UK and Europe, in many places across the world, and now they're switching and looking at ETFs. A mutual fund's performance can be extremely variable. So I think the key risk you take when looking at mutual fund, especially in the active space, and that's where I think the comparison is, you have active manager risk. Now, you do have active managers who are great managers who can outperform, and some of them can outperform really quite consistently. But if you look at the range of active managers, it's also quite difficult for them to consistently outperform. So we can actually see some interesting examples here. This is a study by S&P. And what they've actually shown here is that in the active manager space in the UK for large cap equities, active managers have actually managed to add some value and outperformed. And that's great. So we're not suggesting that you should get rid of all your active managers and simply invest in ETFs. We're saying there are parts of the equity market where active managers find it difficult, more challenging to outperform. In the case of UK large cap equities, probably because the UK large cap benchmark is very concentrated in a number of different names, active managers have been able to outperform. But if you look at some of the data, that doesn't actually feed through across the board in all the different types of asset classes that you might want to invest in. So, for example, they've struggled to add value in UK small cap. So again, having a systematic approach to investing in small cap exposures or small cap indices in the UK would make sense on a passive basis rather than an active basis. Global benchmarks, again, active managers have struggled to outperform and add value. Again, another good reason to look at a very low cost passive index-based product. And in European equities, so Europe x UK, again, a similar challenge in terms of producing outperformance. So I think that's one of the key things when you look at risk between an ETF and people say, well, it trades on exchange, it might be very risky. think about the mutual funds you're invested in and think about the performance risk that you see in that mutual fund. The real risk in a mutual fund is how does it perform versus its benchmark. With an ETF, it will do what it says in terms of tracking the index it's designed to track, and it will track that index less the fees that you can see. And as I say, at least the fees are very transparent when it comes to the ETF market. So what are the major myths that you'll probably have heard or will hear, especially perhaps from mutual fund advisors, about ETFs? One is that all ETFs are the same. Well, actually, I guess when ETFs first started out, they were literally all the same in terms of focusing on very much the same indices, same benchmarks, and very much the same sort of methodologies. But we've seen a huge explosion and growth in the styles of investments or indices and assets that you can actually access via an ETF. So you can have ETFs, obviously, of the UK equity market, small caps, large cap, in Europe, all across the different asset classes globally. In the fixed income market, you have a great number of fixed income products, corporate bonds, Euro corporate bonds, gilts. So a lot of available product there. And different sort of replication methods. I would say the predominant replication method that we see today is physical funds, so a physical fund that will own all the underlying holdings of the index that it's trying to track, or a sample of that. The other myth is that all ETFs are market cap weighted. Again, perhaps when we started out the ETF industry, you would have seen market cap weighted ETFs, the S&P 500 being one of the very earliest. And when you sort of think of Europe, FTSE 100, Euro Stoxx 50, sort of cap weighted benchmarks. But again, we've seen quite a big evolution from that space. And so there are very many different types of fundamentally weighted indices weighted by particular factors or by dividends. And again, those sort of alternatively weighted smart beta approaches are bringing added value to you, the end investor, again, in the same sort of transparent and liquid format that you can see. So effectively a product that you would understand and be familiar with. Another myth is that all ETFs are passive. Clearly, the majority of ETFs, as we've just discussed, are passive, but there is a scope to have active ETFs and some actively managed ETFs which have recently come to market from a number of different issuers. But not all ETFs are passive. Some of them, especially in markets which can be particularly difficult, emerging market bonds, for example, is a very good place to look at, where a slightly more active strategy rather than a benchmark strategy may well in fact be more appropriate. As I said, often people say ETFs are riskier than mutual funds. We would argue that that's really not the case. When you buy an ETF, not only do you see the transparency of the underlying holdings, but you'll typically find that when they track an index, it'll be a much broader index. You'll have less single stock concentration risk than you would have with an active manager. And he or she might like a particular stock and have an overweight in that stock, because that's the active bet they want to take, and that's obviously the active bet that you're paying for in terms of their skill. But it would be wrong to say, in many respects, that ETFs are riskier than mutual funds. ETFs are typically far more diversified in terms of managing risk. That sort of full transparency and full disclosure is really important. You can understand the risk of what's in an ETF at any point in time. That's, I think, a very important part of the product. And the performance of stocks and mutual funds is superior to ETFs. Well, again, coming back to that report that we saw in the data from S&P, that's not the case. And that's also not the case, not just in Europe or with UK managers, but S&P started that analysis of active fund manager performance in the US and found very much the same results, that active managers struggle to outperform and struggle to outperform consistently. Again, not all active managers. You do find some great active managers and star names, and they gather a lot of assets. But you do find it's very hard to do that consistently. And even the very best active managers, when they get to a certain scale, they actually find it difficult to outperform because their funds become so large. How do they actually add some alpha without taking too much risk? The other sort of myth is ETFs are more expensive than mutual funds. Clearly not the case. You're very transparent. You can look at all the TERs of any of the ETFs you care to look at in the European marketplace, and they're very much cheaper than the equivalent mutual fund. Even if you take into account trading costs, ETFs generally have lower costs than mutual funds, and they have a fairer way of dealing with how costs are attributed within a fund. So ETF pricing and trading. So clearly one of the important features of an ETF is that you can trade it on the secondary market, on a stock exchange and settle it in Crest. The shares can be created and redeemed depending on market supply and demand. So there's specialist traders called authorized participants that can deal directly with the fund. And they're the people who help, as it were, keep the price of the ETF in line with its net asset value. And that's very important, because if it were to deviate away from the net asset value, then that's clearly not a good thing for you, the end user or the investor in the ETF. So making sure that the ETF trades in line with the NAV, which is based on the underlying securities in the basket, is very important. You get an NAV which is calculated at the end of each trading day, and during the trading day you'll have an indicative NAV, effectively giving you a guide as to where the NAV should be for that particular product, which is very easy if it's just a basket of UK equities, quite easy if it's a basket of European equities, perhaps more difficult if it's a global basket of equities where perhaps some markets are shut and some markets are open, when you might be trying to trade the ETF in say, the UK time zone on the LSE. But still, you'd have an indication of what the NAV should be. So again, the market price will be determined by the movements in the underlying markets of the ETF trading during that day. And also, when you've got markets which are shut, doesn't mean that they're shut in the sense that there will always be someone else willing to make you a price which is effectively the expected value of that market. So perhaps, if you're looking at an S&P 500 ETF that trades on the LSE in the morning before the US market is open, the price of that ETF is likely to reflect where the futures market is pricing where the US market will open. So you have price discovery, you have a very tight process. But what it does mean is that you can trade the US market before it's open with a fair price, where that price discovery is coming in and taking in as much information as possible from the other markets that exist around the world. Clearly, they can be listed across multiple exchanges in Europe, so you're not just constrained in terms of trading products in sterling. You'll find dollar listings and other currencies of listing as on the LSE. And actually, in terms of traded volumes, it's interesting to see in Europe, traded volumes are about 9% of cash equity market volume, so a meaningful amount, up from about 7% in 2011 and about 5% in 2008. The equivalent figure in the US market was about 24%, so almost a quarter of all the trading volume that you see on the NYSE is actually done in ETFs. So again, you can see they're a very important part of the investment landscape in the US, and a growing part of the investment landscape that we see in Europe. And again, that's a trend that we expect to continue to grow over the next few years. Just looking at the turnover across some of the different exchanges, and the LSE is actually number one in terms of traded volumes across European exchanges. Part of that is because all ETF trades on the LSE have to be reported and printed, so you tend to see higher figures. But I think what is important, just in absolute terms, you can see, for example, in July of this year, just on the LSE, you had 21.2 billion euros of trading volumes in ETFs. And you can see generally very high levels of traded volumes across all the European exchanges. So thinking about ETFs, they're not a niche product. They've got a great percentage of, $500 billion of total AUM, and some quite impressive trading statistics, which have been growing over time. Liquidity is also something people focus on when they sometimes look at an ETF and think, well, actually, does that ETF and the liquidity that I see on the screen, is it a real liquidity that I can actually trade? What's really important to understand with an ETF is that it's always as liquid as the underlying securities. So a FTSE 100 ETF should actually be as liquid as all the underlying securities within the FTSE 100, simply because either the market maker or the other trading participants can actually create and redeem. So they can access the underlying securities, so they can provide that liquidity to you. So the liquidity isn't just what you'll see on a bid-offer spread. You're able to trade in reasonable size. And so even if something looks as though it's not liquid, you normally find that if you try and access that market liquidity, there will be liquidity there and people will put up bigger prices and sizes. And here's an example of, I would say, notionally an ETF that doesn't appear to be that liquid. You can see it's only traded 4,000 shares on that particular day. It's got a bid-offer spread, and you can see there's 10,000 shares on the offer, 3,590 shares on the bid. But the sort of the implied liquidity, i.e. how much could you actually trade of this ETF, is actually 9.6 million shares. This is a figure calculated by Bloomberg. And it actually says that in reality, you could trade without having any market impact, actually over 100 million euros of this particular ETF. So it's not all down to what you might happen to see on the screen at any one point in time. There's a lot more depth to the underlying ETF, and it's the liquidity in all those underlying securities, which is actually the most important feature. So what are the key considerations that you, the end investor, should think of when using ETFs? Clearly, you need to think of them in terms of having some risk. So the risk is the risk of the market that you're accessing. So you're accessing emerging markets, that is going to be a riskier market to access than perhaps UK large cap equities. Or if you're accessing, Brazilian equities are going to be riskier than US equities. So important to understand the ETF that you're using, the asset class or the index that it's tracking, and therefore the risk associated with that. Smart beta strategies, alternatively weighted strategies, do something slightly different from a market cap weighted strategy. So again, I would implore that you understand the exposure that you're looking to get with a particular ETF. So you can get, as I said, get some very exotic exposures, which can be, perhaps not the most suitable for all investors. So it's worth understanding the index again. Understanding the quality of replication of an index, of a tracking error. How well does it deviate from the index it's trying to track? Because whilst I'm saying, and I have said that all ETFs track their indices very well, it's worth looking at the quality of tracking between different providers. A total cost of ownership is not just the TR that you see. You will, because you trade it on exchange, have to look at the bid-offer spread. That's also important. And you're then going to have some form of commission fee as well if you're trading as you would through a broker. There are some different types of replication in the ETF market. A physical fund which will own the underlying equities or bonds, or a synthetic fund which will use a derivative in order to deliver the returns that you have. Liquidity, as we've just discussed, liquidity isn't just what you see on the screen, it is much broader than that. And it's also important, as I say, understand the asset and understand when to trade. So for example, if you were to trade a US equity ETF, you will have much tighter spreads once the US market is open, because all the market makers or authorized participants can hedge themselves very easily, than perhaps you would at 8 o'clock or 8:30 in the morning London time, where it's perhaps harder to hedge yourselves. Or if you've got a product which is also an ETF which is listed in the US market and you're buying the equivalent product in Europe as a UCITS fund, again, if it's when you trade it when the US market's open compared to just trading it in the European time zone, you will have tighter spreads and better liquidity. So other areas and other ways that people access ETFs is on platforms. And that's very much what happens here, I would say, for a lot of investors who use IFAs. They will use a platform in terms of accessing their ETFs. Unfortunately, it's probably fair to say platforms historically have been much more attuned to working with the mutual fund industry. And that's very much a function of how platforms and mutual funds have grown over time. And also, most platforms aren't actually set up to trade on exchange in the same way that you would need in terms of accessing ETFs. But that is changing. You will find that there are platforms out there today which have a much better visibility and access to exchanges and have the ability and have ETFs on them. So look at that and make sure that your platform supports the ETF. If it doesn't, actually the way to actually get an ETF on a platform is to actually ring up and ask them to put it on there, because a lot of platforms work on the basis that if there's sufficient client demand, they will make the product available. ETFs are very efficient products. There's no reason why they shouldn't be on your preferred platform. So what is the evolution that we've actually seen in ETFs? What are the way things are changing? So as I said, the majority of ETFs are based on market capitalization weighted indices, so indices that you might be familiar with, S&P 500, FTSE 100, the DAX in Germany. But actually there's some evolutions in what's happening in sort of the index space and the investment space. And so you're seeing some alternative strategies come to the market where people think that perhaps some slightly more efficient ways to have market access, and perhaps there's some slightly more efficient ways to generate returns over the long run. So at WisdomTree, one of the things that we do is we have some fundamentally weighted indices, working off the hypothesis that was worked on by Professor Jeremy Siegel. He's a professor at Wharton Business School. And he's observed over time that dividends are one of the most powerful ways of investing generally in equities. And he did a long-run study of the US equity market. He's done it for the UK and Europe. And it shows that buying stocks that pay dividends or have higher dividends over the long run gives you better risk-adjusted returns. And the important point here is it gets around the noisiness that you see in market cap-weighted indices, where perhaps you have a lot of volatility, a lot of risk, and a lot of momentum from time to time. So smart beta can be a number of different things, a number of different products in the marketplace. So these aren't ones we focus on ourselves, but we have fundamentally weighted indices, and in WisdomTree we have dividend versions of that. You have equally weighted index, so that's a different style from market cap. It's very simple to understand. You just equally weight all the stocks in the index, equally weighted versions, for example, the S&P 500. You have factor-based indices, and that will be based on different fundamental factors, be it quality factors or income factors or particular stock-related factors. And you have indices which are designed to have lower volatility overall. So this is one way you can see the evolution of not just ETFs, but the indices underlying the ETF product space. And if we think of fundamentally weighted indices, well, as I say, WisdomTree, we do have some smart beta indices, and we've launched this sort of dividend-weighted strategy, launched it in the US in 2006. And we do believe that dividends is a quality measure for companies. Companies that consistently pay dividends have an element of a quality approach to them. We think it's an objective measure, especially when you go across markets where accounting treatments can vary across different markets. It's an objective measure of a company's health and value and profitability. And we use a proprietary methodology to actually build these indices. And we're kind of unique in terms of building our own indices, launching ETFs, but having the indices independently calculated by S&P as an external independent provider. And just a couple of interesting themes. Equity income and dividend strategies. Well, these strategies using that sort of dividend approach means that you can actually access some very interesting parts of the equity market in a way that delivers very interesting long-term returns. So the income strategies focus on higher yielding equities. Again, the dividend screen means you have a quality tilt there. And you have an annual rebalance, which means you sort of rebalance to the underweighted, sort of undervalued stocks. In the small cap space, again, we use a dividend to screen out what we would think are the lower quality stocks, and we build a small cap index on the back of that. Talking about ETF structures, physical versus synthetic. I think the easiest way to think about this is, the physical ETF is very much like an old mutual fund. It will own the securities that are in the underlying index. And it's the easiest structure for you to understand as a private investor. You go to the website, you look at a particular ETF, could be a WisdomTree ETF, iShares ETF, typically physical funds, click through to the holdings, you will see the holdings that are in that fund. So very easy and intuitive for you to understand. A synthetic ETF uses a derivative, a swap, has some collateral. Swap-based ETFs are probably harder to understand, but can still be very important. So if you wanted to access, for example, commodities and a broad commodity index, which could have precious metals, energy, all sorts of different characteristics, you can't do that physically. You're not going to physically go off and own oil. You can physically own gold, but all those other assets within the commodity space you're not going to do. So having a swap-based ETF in the commodity world is pretty much the only way you can efficiently access that. But in sort of equities and fixed income, the simplest way to access those markets is with a physical product. And they do now dominate the market. Here's some of the trends over time. So historically in Europe, actually there were a very high number of synthetic swap-based ETFs. The history of that is that a lot of those products were launched by investment banks in Europe. What you've seen is that the physical funds have grown over time. And actually, just in pure numerical terms, there are actually more physical funds in Europe now than there are swap-based funds. And in terms of total AUM, for a long time, you've actually had much higher AUM in physical funds than swap-based funds. And I think the important point about a physical fund is it lends itself to both the efficiency and the transparency that people typically want to see within an ETF. So just to conclude, ETFs are a great product, a great tool for you to use as long as you understand all the risks. It's the fastest growing part of the asset management industry. Actually recently overtook hedge funds in terms of assets under management. They're very liquid, it's a very robust structure. They are UCITS funds. And they're typically very low fee and tax efficient. And they're a very easy way for you to gain access to different markets, different styles and different exposures. And I think importantly, if we look at the way ETFs have evolved over time, straight beta, i.e. market cap weighted indices, is a very mature place. And you have very cost efficient investment vehicles in that space from an ETF perspective. Smart beta is a growing area. I would still call it niche in terms of the proportion of ETFs which follow a smart beta strategy, but it still offers you interesting exposures, and it's a very nascent sort of growth in sort of active management of ETFs, which is a very sort of different area and one that I think is going to grow over time. But really, if you think about ETFs, they are really the future of the asset management industry, both based on what we believe the products are in terms of how well they behave and how well they deliver what they targeted to do, and at the growth that we've seen both in the US market and the European market, we think that will continue over time. Thank you.